Imagine getting paid every single month without lifting a finger. Sounds great, right? Well, that's exactly what monthly dividend ETFs can do for you. Whether you're looking to supplement your income or just love the idea of building wealth while you sleep, monthly dividends give you that steady, predictable cash flow. In today's video, I'm going to show you the top 4 dividend ETFs that pay out every month, so you can start seeing those returns hit your account more often. We'll break down each ETF, look at how they work, and most importantly, how they can help you achieve your financial goals. Before we dive into these hidden gems, do me a quick favor. Hit that like button, subscribe, and let's get started on building your wealth with smart, strategic investments. Before we dive into the specifics of each ETF, let's talk about why monthly dividends are such a big deal. Most dividend-paying stocks and ETFs only pay out quarterly, but monthly dividends provide several key benefits that can make a real difference in your portfolio. First, the power of compounding works faster with monthly dividends. By receiving payments more frequently, you can reinvest that income sooner, accelerating your wealth-building process. Whether you're reinvesting for growth or taking those payments for income, getting paid 12 times a year instead of just 4 can make a huge impact over time. Second, monthly dividends provide consistent cash flow. This is particularly valuable if you're relying on dividends to cover living expenses, or if you just like the idea of seeing returns more frequently in your account. With quarterly payouts, you have to wait 3 months between payments, but with monthly dividends, that income is steady and reliable. Finally, monthly dividends can make your investment strategy more flexible. If you need to access your cash quickly, monthly payouts give you more liquidity options without having to sell your shares or wait months for the next payout. In short, monthly dividend ETFs offer not only convenience, but also financial advantages that can help you meet your goals faster and with more certainty. Let's start with a closer look at the JPMorgan Equity Premium Income ETF JEPI, a fund designed for those seeking both income and growth. As of September 2024, JEPI boasts an impressive $35.16 billion in net assets, reflecting its strong market presence. Priced at $59 per share, this ETF has become a go-to for income-seeking investors, thanks to its 12-month rolling dividend yield of 7.55% and a 30-day SEC yield of 6.88%. These yields rank JEPI in the top half of its category, and with an annual dividend payout of $4.19 per share, it offers a steady income stream. Not only does JEPI provide attractive dividends, but it also comes with a competitive expense ratio of just 0.35%, making it cost-effective compared to similar funds. When it comes to performance, JEPI has delivered solid returns, with a year-to-date return of 12.84% and an impressive 1-year return of 15.70%. Over the past 3 years, it has posted an average annual return of 8.20%, demonstrating its consistent ability to generate both income and growth for investors. JEPI's portfolio includes 133 holdings, with its top 10 holdings accounting for 17.95% of its total assets. The fund is diversified across various sectors, with technology leading at 19.81%, followed by healthcare at 15.29%, and financials at 11.44%. Key companies in JEPI's top 10 holdings include household names like Meta Platforms, Amazon, Microsoft, and MasterCard, showcasing the strength and stability of the companies backing this ETF. With this blend of income and growth potential, JEPI stands out as an excellent option for investors seeking monthly dividends alongside a well-diversified portfolio. Next up is the JPMorgan Nasdaq Equity Premium Income ETF JEPQ, a standout choice for investors seeking high income from some of the biggest names in tech. As of September 2024, JEPQ manages a robust $15.955 billion in net assets with a market price of $54 per share. One of the most appealing aspects of JEPQ is its dividend yield of 9.47%, which is notably higher than many other ETFs. Over the past year, JEPQ paid an impressive $5.08 per share in dividends, distributed monthly, making it a great option for investors seeking consistent income. Additionally, it offers a competitive expense ratio of 0.35%, meaning investors benefit from relatively low fees for such high potential income. From a performance perspective, JEPQ shines with a year-to-date return of 16.27% and an outstanding one-year return of 24.53%, highlighting its ability to generate strong returns alongside its high-income payouts. While its track record is shorter than some, JEPQ's combination of growth and income potential makes it an attractive option for long-term investors. JEPQ's portfolio is heavily tilted toward information technology, which makes up 39.1% of its total assets, followed by communication services at 13.3% and consumer discretionary at 10.6%. The ETF holds 88 positions in total, with its top 10 holdings accounting for some of the most powerful companies in the market, including Apple Inc. at 7.64%, Microsoft Corporation at 6.80%, and Nvidia Corporation at 6.63%. Other notable holdings include Amazon, Meta Platforms, Alphabet, and Tesla, making JEPQ's portfolio a who's who of the tech world. With its high yield, low expense ratio, monthly dividends, and exposure to some of the most innovative companies globally, JEPQ is a compelling option for those looking to blend tech growth with a steady income stream. Next in our list is Invesco S&P 500 Low Volatility ETF, SPLV. The Invesco S&P 500 Low Volatility ETF, SPLV, is designed for investors seeking steady returns with reduced volatility. As of the latest data, SPLV manages a substantial $7.515 billion in net assets and trades at a market price of $71 per share. One of its attractive features is its relatively low expense ratio of 0.25%, making it an efficient option for long-term investors focused on keeping costs down while benefiting from market exposure. The ETF offers a modest dividend yield of 2.04% as of September 2024, providing consistent, albeit lower, income compared to high-yield funds. From a performance standpoint, SPLV delivers solid returns while keeping risk in check. It boasts a year-to-date return of 15.16% and a one-year return of 21.17%, with a three-year annual return of 7.83%. Impressively, the ETF's 5-year average annual return is 23.54%, and over 10 years, it has achieved a 9.60% average annual return. These numbers highlight its ability to generate long-term gains while focusing on low-volatility stocks, making it a strong choice for investors looking for stability without sacrificing performance. SPLV holds 102 positions, with a diversified portfolio across several sectors. The fund is heavily weighted in financial services, which make up 22.17% of the total portfolio, followed by consumer defensive stocks at 15.30%, industrials at 12.21%, and utilities at 12.14%. Its top 10 holdings include well-established companies like Berkshire Hathaway Inc. at 1.47%, the Coca-Cola Company at 1.34%, and T-Mobile U.S. Inc. at 1.25%. Other notable names include Lowe's Corporation, Republic Services, Inc., and Visa Inc., all contributing to the ETF's balanced approach. By focusing on stocks with lower volatility, SPLV aims to minimize the swings often associated with the broader market, making it an ideal option for investors who prioritize consistent performance with lower risk. Next in our list is WisdomTree U.S. Large Cap Dividend ETF DLN. The WisdomTree U.S. Large Cap Dividend ETF DLN is a popular choice for investors looking to capture both capital appreciation and consistent income through dividends. As of September 2024, DLN manages $4.25 billion in net assets and trades at a market price of $78 per share, making it a well-established player in the large-cap dividend space. One of the fund's key advantages is its expense ratio of 0.28%, which keeps costs relatively low for investors, ensuring that more of the returns flow into their portfolios. DLN offers a respectable dividend yield of 2.05%, making it a solid option for income-seeking investors. The fund's performance has been equally compelling, with a year-to-date return of 17.69% and an impressive one-year return of 23.94%, outperforming many of its peers. Over the longer term, the ETF has generated a 3-year annual return of 10.23%, showcasing its ability to deliver consistent growth over time. DLN's portfolio consists of 306 holdings, with a strong focus on high-quality, dividend-paying companies across various sectors. The largest sector allocation is in technology, representing 20.25% of the portfolio, followed by financial services at 16.97% and consumer defensive stocks at 13.37%. Other notable sectors include healthcare, 13.27%, and industrials, 7.70%, ensuring broad diversification across the market. The top 10 holdings account for a significant portion of the portfolio, led by Apple Inc. at 3.70%, JPMorgan Chase & Co's at 3.47%, and Microsoft Corporation at 3.28%. Other major positions include ExxonMobil Corporation, AbbVie Inc., and Johnson & Johnson, providing a mix of technology, healthcare, and financial stocks. With its broad exposure and focus on large-cap companies, DLN offers a balanced approach to dividend investing, making it a compelling choice for those seeking both growth and income. Whether you prioritize high dividend yield, stability, or growth potential, these 4 ETFs each offer unique advantages. JEPI and JPQ are your go-to options for high-yield, consistent monthly dividends, while SPLV provides a lower-risk strategy for those seeking less volatility. DLN, on the other hand, offers a balanced blend of growth and income with broad sector diversification. So which one fits your strategy? Let me know in the comments. And if you're serious about building passive income and growing your portfolio, be sure to hit the like button, subscribe to the channel, and turn on notifications so you never miss out on more investing insights. Thanks for watching, and I'll see you in the next video.